Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. Wow, what a day yesterday was in the markets. That nearly 5% drop in the S&P 500 on Thursday really got the financial world buzzing. You've got to be wondering, was that the kind of big flush we sometimes see right before the market finds a bottom, or something more fundamental shifting under the surface?
That's absolutely the central question right now. A move like that always prompts speculation about whether we're seeing, capitulation or maybe the start of a deeper trend.
Exactly. So for this deep dive, we've gathered a range of perspectives from across the financial press, CNBC, Bloomberg, MarketWatch, and the Wall Street Journal, all reporting around April 3rd and 4th, 2025. What's striking is how each of these sources, while covering the same core event, offers a slightly different lens through which to view it. Our goal today is to synthesize all of that for you, to pull out the most critical insights and really understand what these headlines are telling us about the underlying forces at play and, well, what it might mean for your financial picture. Okay, let's unpack this, shall we? The clear catalyst, the thing that seems to have ignited this sell-off, was President Trump's announcement of new tariffs.
That's right. According to a Bloomberg article, this announcement came after the market's close on Wednesday and really took Wall Street by surprise. The general consensus seemed to be anticipating a less aggressive move.
And the market's reaction, as Bloomberg also pointed out, was remarkably broad. There's a quote in their piece from J.C. O'Hara at Roth Capital Partners saying, basically everything is lower. He made a key distinction, noting that unlike some previous risk-off days, this wasn't a situation where you saw defensive sectors holding their ground. This felt much more like a widespread reassessment.
What's particularly noteworthy, expanding on that point about the breadth, is that even sectors seemingly removed from direct tariff implications felt significant pressure. Bloomberg highlighted the financial sector. Banks weren't directly targeted by these tariffs, yet the KBW Bank Index, that's a key index tracking major U.S. banks, experienced its worst day since the regional banking concerns back in March of 2023.
That's a really important point, and O'Hara specifically flagged the SPDR S&P Bank ETF, that's an exchange-traded fund, tracking bank stocks falling below $50 as a concerning milestone. He views banks as a leading indicator of potential structural weaknesses in the economy, so that move is definitely something to pay close attention to.
Absolutely. And then consider the semiconductor sector. The VanEck Semiconductor ETF, focused on semiconductor companies, really got hit hard, sinking to its lowest level since February 2024 and breaking through several support levels that technical analysts were watching closely. John Kolovis at Macro Risk Advisors had a rather blunt assessment, stating that these areas are guilty until proven innocent.
Ouch. And it wasn't just the tech-related areas. Homebuilders also saw a significant downturn, didn't they? Bloomberg reported a sharp 7.1% drop, pushing them 17% below their 200-day moving average, the largest single-day decline since June 2020. They're really in a tough spot, caught between rising interest rates, anxieties about economic growth, and now the prospect of higher input costs due to these tariffs.
Exactly. It's a confluence of negative forces converging on that particular sector. And we also saw transportation stocks officially enter bear market territory. As Bloomberg noted, this is often interpreted as a broader signal of increasing unease about the overall economic outlook, as transportation trends can reflect, the movement of goods and services.
And the contrast between consumer discretionary and consumer staple stocks was also quite telling, wasn't it? The Bloomberg article highlighted that discretionary stocks, things people buy when they feel confident, had their worst day relative to consumer staples, essential goods, since the period following 9/11. That's a really stark illustration of a significant flight to safety.
It is. As Todd Son at Strategas Securities put it, investors were essentially sprinting towards cash, cash and more cash, or just really defensive consumer staples. That level of extreme risk aversion really underscores the depth of the concern that rippled through the market.
And this wasn't just a U.S. phenomena. The Wall Street Journal reported that European bank stocks also experienced extended losses, and they specifically linked that to concerns about global trade and the potential knock-on effects on economic activity worldwide. The Stoxx 600 banking sub-index, a broad measure of European bank performance, saw a significant decline as well.
If we connect this to the bigger picture, what we're observing is a synchronized negative reaction across global markets, particularly impacting sectors that are highly sensitive to economic growth and overall financial stability.
Okay, so we've established the immediate cause, the tariff shockwaves, and the broad nature of the market's response. But the crucial question we started with was whether this was panic selling, indicative of a potential bottom, or a more rational reaction to evolving economic realities. The CNBC article you mentioned, titled Behind the Market Route, really delves into this aspect.
Yes, that CNBC piece focused on the discussion between John Malloy and Mike Santoli, where they were specifically analyzing whether the market action exhibited the characteristics of those deep, indiscriminate sell-offs that often precede a market bottom. They were examining market internals, things like trading volume and the breadth of advancing versus declining stocks to see if that kind of classic panic was present.
And one key indicator they highlighted was the significant jump in the CBOE Volatility Index, or VIX, often called Wall Street's fear gauge. As you'd expect during a sharp sell-off, it saw a notable increase.
What's interesting, though, is that the CNBC piece also raised the possibility that some investors might still be hoping that these newly announced tariff rates are primarily a negotiating tactic, that they could eventually be scaled back. That perspective suggests that perhaps it wasn't a complete and utter everyone running for the exits scenario across the board.
That's a valid point. It's plausible that some market participants are thinking this is maybe temporary.
Yeah.
But then you have analysis like the one from Morgan Stanley's Mike Wilson, which MarketWatch covered. His assessment seems to take a more fundamental view of the potential longer-term consequences.
Exactly. Wilson is now pointing to the 5,100 to 5,200 level as the next key support range for the S&P 500, whereas he now sees the 5,500 level acting as a significant resistance point, a ceiling the market might struggle to break through. He acknowledges that the initial impact of the tariffs is likely being factored into prices, but his primary concern revolves around how long these tariff negotiations become and the potential for retaliatory measures from other countries. If it becomes a drawn-out affair, he believes the risk of a recession significantly increases.
So while some might be looking for a quick bounce back based on hopes of a swift resolution, others, like Wilson, are clearly bracing for a potentially more prolonged period of uncertainty and economic risk. This directly ties into the growing concerns about a potential recession that MarketWatch also emphasized quite prominently in another article.
Yes. The headline, "Recession Fears Roiled U.S. Markets After Trump's Tariffs," really encapsulates the prevailing sentiment. The fact that the Russell 2000 index, which tracks smaller companies, officially entered bear market territory defined as a 20% decline from its recent peak, is another significant data point fueling those recession anxieties.
And Bloomberg also highlighted the renewed inversion of the bond yield curve. They pointed out that stocks and bond yields, which often move in opposite directions, are now moving in tandem again, but this time they're both heading downwards. This is a classic signal that market participants are lowering their expectations for future economic growth. Briefly, an inverted yield curve, where short-term bond yields are higher than long-term yields, is unusual because it suggests investors are more pessimistic about the near-term economic outlook than the long-term.
What's particularly striking are some of the initial economic forecasts trying to quantify the potential impact of these tariffs. Bloomberg cited projections from Nomura anticipating slower economic growth coupled with higher inflation, a potentially challenging stagflationary environment. Barclays even went a step further, predicting a slight contraction in overall GDP. And then you had Jim Zelter from Apollo Global Management stating that he now puts the probability of a U.S. recession at 50% or higher. That's a pretty sobering assessment from a major investment firm.
It certainly is. It really feels like the market narrative is shifting quite rapidly from a focus on continued growth to a much more defensive posture, heavily weighing the risks of an impending recession. Now, one of the more surprising developments that the Wall Street Journal highlighted was the unexpected weakening of the U.S. dollar in response to these tariff announcements.
That's right. Historically, the expectation with protectionist trade policies was often that they would lead to a strengthening of the domestic currency. The logic was, by reducing imports, you decrease demand for foreign currencies and increase demand for your own. So the fact that the dollar actually fell against major currencies despite these new tariffs is a bit of a puzzle for some market observers.
The journal offered a couple of potential explanations for this.
Yeah.
One was the idea that these tariffs themselves might be eroding faith in the long-term economic potential of the U.S., creating uncertainty that outweighs any perceived benefit to the dollar. The other, perhaps more significant suggestion was a gradual erosion of the U.S. dollar standing as the primary global reserve currency.
That second point carries significant long-term implications. If other countries and institutions begin to perceive the U.S. as a less predictable or reliable partner in global trade, it could incrementally diminish the dollar's dominance as the preferred currency for international transactions and as a store of value in central bank reserves.
It's definitely a longer-term trend to keep an eye on. Now, shifting gears a bit, MarketWatch also featured some commentary from the legendary investor Bill Gross, and his message was quite direct and cautionary. Don't buy the dip.
Yes, he invoked that classic Wall Street adage, don't try to catch a falling knife, suggesting that investors shouldn't assume that the recent declines represent a buying opportunity, as prices could very well continue to fall. He characterized the current situation as an epic economic and market event with potentially significant negative consequences still to unfold.
Interestingly, while advising against buying the broader market, Gross did highlight a few specific domestic companies with relatively stable dividends, names like AT&T, Verizon, and Altria. And what's particularly noteworthy is that these very stocks actually saw gains on Thursday while the rest of the market was experiencing those sharp declines. That really underscores the strong investor preference for safety and reliable income in this environment.
It certainly does. Investors are clearly prioritizing the preservation of capital and looking for consistent returns in the form of dividends amidst a landscape of considerable uncertainty and volatility.
Now, let's delve into how these tariffs might be specifically impacting different sectors and individual companies. Bloomberg ran a really interesting piece on the potential disruption to the Bitcoin mining supply chain.
What's fascinating there is that while a significant number of Bitcoin mining operations are located in the US, which might initially sound like a boost for domestic industry, the specialized hardware required for Bitcoin mining is overwhelmingly manufactured in Asia. So these new tariffs could lead to a substantial increase in costs for US-based Bitcoin miners.
And the broader technology sector also appears to be particularly vulnerable to these tariffs, as highlighted in a MarketWatch article titled, "Should You Sell These 5 Tech Stocks Heavily Exposed to Tariffs?"
That article really emphasized the intricate and global nature of supply chains for many technology companies, especially those involved in hardware manufacturing. They specifically mentioned countries like Vietnam, China, India, Taiwan, and Malaysia as key links in these supply chains that are now facing these new tariff levies. The article even quoted Gil Luria from D.A. Davidson, calling this development the biggest change to the economic outlook since the first day of COVID.
Wow. And it's not just about the direct increase in the cost of imported components. Luria also anticipates that major tech companies with significant capital expenditure budgets, like Microsoft, Meta, Google, and Amazon, might reconsider or scale back their massive investments in data center infrastructure in order to manage their overall capital spending in the face of rising tariff-related costs. This could, in turn, have negative consequences for the companies that supply the equipment and services for these data centers, like, networking hardware providers.
Exactly. The MarketWatch piece, drawing on analysis from JP Morgan, specifically identified companies like Dell, Cisco, and Hewlett-Packard Enterprise as likely candidates that might need to increase their prices to offset the higher costs resulting from the tariffs, given their significant exposure to hardware manufacturing and global supply chains. They also noted that companies like Super Microcomputer and Qualcomm appear to have less direct exposure. And while Apple might also face pressure to raise prices, they possess greater flexibility in potentially shifting their manufacturing operations to mitigate some of the impact.
So it's a very nuanced situation with varying degrees of vulnerability even within the seemingly monolithic tech sector. And speaking of broader economic uncertainty influencing business decisions, the Wall Street Journal had an exclusive report detailing that Deloitte is laying off a number of U.S. consultants following a recent push by the government to reduce costs on consulting contracts.
While not directly a consequence of the tariffs, this move by Deloitte does suggest a broader trend of increased caution and cost-cutting within the business environment, particularly in sectors like consulting that often serve as a barometer for overall economic activity. The government's focus on lowering contract expenses is another contributing factor in this specific instance, too.
Now let's pivot to the global reactions we're seeing. Bloomberg's Stock Market Today analysis really painted a picture of widespread market turmoil internationally, suggesting that this America First trade policy appears to be having a destabilizing effect on global markets.
It's certainly interesting to observe the geopolitical ramifications beginning to emerge. Bloomberg's coverage of Romania's repeat election also mentioned French President Macron explicitly urging EU businesses to halt spending in the U.S., and Japan reportedly declaring a national crisis in response to these developments. These are quite strong statements indicating a significant level of international concern regarding the implications of these tariffs on the global economic order.
And that same Bloomberg article touched on a number of other significant global events unfolding concurrently: the repeat election in Romania, the removal of South Korea's president, ongoing U.S.-Russia talks regarding Ukraine, all of which contribute to a general sense of heightened global uncertainty, even if they aren't directly caused by the tariffs themselves.
What's particularly puzzling, as highlighted in Bloomberg's piece titled Trump Tariffs, what in the world does the U.S. want from Nauru? Is the inclusion of the tiny island nation of Nauru on the list of countries facing these new tariffs. Given the minuscule amount of trade between the U.S. and Nauru, the economic rationale behind imposing a 30% tariff on them is frankly quite perplexing.
It really does make you wonder about the broader strategic thinking, or perhaps even the process, behind these tariff decisions when you see such an anomaly. Now let's consider the implications for the Treasury market. Bloomberg published an article posing the question: Treasuries at risk of foreign buyer strike and tariff retaliation.
This brings up a critical point about potential unintended consequences. If major foreign holders of U.S. government debt, particularly countries like China and Japan, decide to reduce their purchases of Treasury bonds as a retaliatory measure against these tariffs, that could have significant ramifications for U.S. interest rates and the cost of borrowing for the U.S. government.
However, there does seem to be some debate on the likelihood and impact of such a move, doesn't there? While some analysts see it as a tangible risk, others argue that U.S. Treasuries remain such a fundamental and essential asset in global investment portfolios that foreign buyers might be hesitant to significantly reduce their holdings. There are few truly comparable alternatives in terms of safety and liquidity, right?
Exactly. As Jim Caron at Morgan Stanley Investment Management pointed out, such a move by major foreign holders could be very self-defeating and ultimately cost you a whole heck of a lot in terms of their own investment returns.
Now, all eyes are going to be on Federal Reserve Chair Jerome Powell's upcoming speech and the release of the March non-farm payroll report, both of which were scheduled for Friday. MarketWatch's article emphasizing the growing recession fears underscored just how crucial these events will be in shaping the market's near-term direction amidst this heightened anxiety.
Investors will be particularly focused on any signals from Fed Chair Powell regarding how the central bank is viewing this increasingly complex economic picture. As Seema Shah at Principal Asset Management described it, the Fed is now facing a potentially challenging policy predicament, where tariffs could simultaneously fuel inflationary pressures while also increasing the risk of an economic downturn. That's a very difficult balancing act for monetary policy.
And the consensus expectations for the March jobs report, as noted by both MarketWatch and Bloomberg, were for a slight moderation in the pace of payroll growth, but with the unemployment rate remaining relatively stable. However, as Julian Lafargue at Barclays pointed out, this backward-looking economic data might already feel somewhat outdated, given the rapid and significant developments on the trade front this week.
That's the inherent lag in economic data. The jobs report reflects labor market conditions for March, prior to the full impact and market reaction to these new tariffs. So while the numbers themselves will still be scrutinized, the market's reaction will likely be heavily influenced by Powell's forward-looking commentary and any indications of how the Fed perceives the implications of these trade policies for the future economic outlook.
Briefly touching on another area of potential policy impact, MarketWatch also reported that the Trump administration is considering potential changes to income-driven repayment plans for federal student loans.
This is another policy area where potential changes could have significant financial implications for a large number of individuals. The article suggested that the proposed revisions might make these repayment plans less favorable for borrowers, although the details are still emerging and subject to the regulatory process.
And finally, a global perspective. Bloomberg's report on the gender pay gap in the UK financial sector highlighted the persistent disparity, with women still earning, on average, about a fifth less than their male counterparts. The article also raised the point that broader economic and political uncertainties, potentially including the U.S. administration's stance on diversity and inclusion initiatives, could indirectly impact the progress towards gender equality in the workplace globally.
It serves as a reminder that these large-scale economic and political shifts can have far-reaching consequences, potentially influencing various aspects of the global landscape, including social and workplace dynamics that might not seem immediately connected to trade policy.
So just to quickly bring it all together, the market experienced a significant and broad sell-off on Thursday, largely triggered by President Trump's unexpected and extensive tariff announcements. This move ignited widespread selling across nearly all sectors and has significantly elevated concerns about a potential economic slowdown and even a recession. The surprising weakness of the U.S. dollar in the face of these protectionist measures was a key and somewhat unexpected development. While some investors might be hoping for a quick market rebound, many experts are currently advising caution, pointing to the significant uncertainty and the potential for further market downside. The upcoming jobs report and, perhaps even more critically, Fed Chair Jerome Powell's remarks on Friday will be absolutely vital in setting the tone for the markets in the near term.
This deep dive really underscores the intricate web of interconnectedness that defines global financial markets and how swiftly major policy decisions can cascade across different asset classes and geographical regions. The initial market reaction has been undeniably negative, but the ultimate long-term consequences will depend on a complex interplay of diplomatic negotiations, potential retaliatory actions from other nations, and the fundamental impact on global economic growth and inflation.
Considering this intricate web of global markets and the multifaceted reactions we've seen to these tariffs, it really makes you think about what other unintended consequences might unfold in the coming weeks and months, both in terms of economic ripple effects and broader geopolitical dynamics. It's definitely something important for you to keep in mind as we head into the weekend.
Absolutely. There are many layers to this evolving situation, and the initial shockwaves we experienced yesterday are likely just the beginning of a much larger and more complex narrative playing out on the global stage.
Well, that's all the time we have for our deep dive today. We sincerely hope this has provided you with a more comprehensive understanding of the market dynamics that have been triggered by these major financial headlines. We'll see you all Monday morning with new headlines from major financial magazines.